Goldman Sachs has just sent a warning about an upcoming correction, and Ray Dalio, one of the biggest hedge fund managers in the world, recently said, the picture is pretty clear. We are in the territory of a bubble. Now, right now, despite the pullbacks we've seen in November, the stock market is trading just below its most recent all-time high in terms of price. AI stocks are booming, and everyone, and I mean everyone, feels rich. But here's the problem. When stock prices go up this fast and get this far disconnected from their value, smart investors like you start to get nervous. Now, before you panic, don't. Panicking will do nothing. In this video, I'm going to explain what that warning means, how to spot signs of a bubble, and how you, even if you're a beginner, can protect your money while still growing it. Here's a hint. It has to do within here. You're not going to hear me say sell everything or go to cash like other people out there. That's not what smart investing is about. What you'll hear me say will be different than what you typically hear, and we're going to do it all through the lens of principle-driven investing. Now, here is the article behind me from Goldman Sachs. I'm going to share portions of this article from CNBC, and here's what the first paragraph says. Global markets may be due for a reality check after this year's relentless rally, as two of the biggest names on Wall Street, Goldman Sachs and Morgan Stanley, cautioned investors to brace for a drawdown over the next 2 years. In fact, the CEO of Goldman, David Solomon, who is at the Global Financial Leaders Investment Summit in Hong Kong, said, it's likely there'll be a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months. And he also said, things run and then they pull back so people can reassess. As for the Morgan Stanley CEO, he said we should welcome corrections like this. Their warnings came during discussion about how the International Monetary Fund, Fed Chairman Powell, and even the head of the Bank of England have all raised concerns that stock prices might be getting a little too high. In other words, this is a message coming from other corners of the financial world. Now, before we get further, I want to make note. Nothing that has been said has been based on value yet. So what we're going to talk about here is they're saying, hey, the price has run up a lot. And it's true. The NASDAQ is up almost 50% since the April low. Guys, price tells you nothing. It's price relative to value. We will preach this until we're blue in the face, until YouTube simmers away whatever future holds for it. It is not about just price. It's about price versus value. So if you're new to our channel or investing, let me quickly first off explain what a market correction is. A correction is when the market drops between 10% and 20% from a recent price high. It can last a few days, a few weeks, a few months, and it's usually triggered by some big news like economic changes, rising interest rates, global events, or just plain fear. But here's the key. Corrections are totally normal. Don't confuse a correction with a crash. That's when the market drops hard and fast, and it's also not the same as a bear market, which is deeper, and it's longer drops of 20% that usually last many, many months. I think the average ones are on 1 year. Now, the good news is markets bounce back after a correction. And if you're a long-term investor, these dips can actually be phenomenal chances to buy strong companies at better prices. Guys, I love when the market goes down, but I want to remind everybody, something becoming cheaper does not make it cheap. We're always looking at price versus value. Yes, 10 to 20% pullback makes sense. We had a 50% run up very quickly. At the end of the day, if I have stocks that I've bought recently, which I do, I have 28 stocks in my portfolio. If I have more of those that get cheaper relative to what they're worth, I will continue to buy more. Now, do I think there's something more than a 10 or 20% at some point coming in the next few years? I do. But it still doesn't change the advice I give on this channel. I teach here because I want to tell people fear-mongering is not going to work. Having a plan works. People are fearful when they don't understand what is going to happen or why. When you finally understand why things happen, you will be able to act smarter when it does. The person who understands that things are going well right now, but valuation and price are very disconnected. Price is way higher than value. That's the thing that these supposed brilliant CEOs are not talking about, price versus value. They're only following price. I love what Ray Dalio says here. Don't sell just because there's a bubble. If you look at the correlations within the next 10 years returns, when you're in that territory, you get very low returns. We've talked about this 1,000 times. Where we are in valuations, the next 10 years are going to be difficult. We've said this a lot of times, but that's not the point. The point is, we don't know when things might happen. The fair value on the S&P keeps going up as GDP goes up. Even if the stock market fell tomorrow by 50%, hypothetically, as long as GDP gets better, as long as earnings in the S&P have a long-term trend upwards, you can buy great companies at great prices. You should continue to dollar cost average because your job is to buy at all times. We've done this chart before. This is the long-term value of the S&P. This is the price of the S&P. Your job is to buy all along the way. And many YouTubers steal this from me. You're going to overpay, you're going to underpay. But over a long period of time, you're going to match the market. Now you might be sitting there saying, I don't want to match the market. I want to do better. You can. But just matching the market will crush everyone around you because everybody else sells at the wrong time and buys at the wrong time. That's why you're here. That's why I teach on YouTube. I want to prepare you that when we're down here and all your friends are scared shitless, you sit there and go, but stocks are low. I want to buy these. And you continue to buy. And you load up on individual stocks as they're low because you're going to be the smartest person in the room. While Dalio sees a bubble forming, he said there would also need to be something to pop it. The billionaire investor said it's unlikely to be tighter monetary policy, but it could come from higher wealth taxes. I don't agree with this statement. There would also need to be something to pop it. The dot-com bubble just ended. March of 2000, nothing happened. There was no instant that occurred that made us so boom. It just, at some point, there weren't enough buyers of stocks, and stocks started to fall, and that was that. Now, there's an 8-minute video linked inside the article. In it, Dalio says the picture is pretty clear. We are in the territory of a bubble, but we don't have the pricking of the bubble yet. His main point, it's not just the price of stocks that matters in a bubble, it's who owns them. Are they held by strong hands or weak hands? Strong hands are investors who can hold through the ups and downs. These are the ones who have a strong stomach. They can sit there and see a stock falling and saying, this is what's supposed to happen and this is an opportunity for me. Weak hands, usually retail investors, folks who tend to panic and sell fast when things get shaky. Dalio says if the strong hands keep holding, the bubble might not pop. But if too many weak hands start to sell at once, that's when things unravel. Guys, it will eventually happen. There will eventually be a point when the weak hands start to sell. Why? Because if you don't have enough buyers buying these hype stocks, they're going to go sideways for a while. And when they go sideways for a while and the weak hands are not getting returns, what are they going to do? They're going to find the next shiny object that they're going to invest in. So they're going to sell off the other stuff. When they sell off the other stuff, what happens to the price? You could not see anyone in the world to say that Amazon was not a great business after COVID. Here's the 10-year chart. And Amazon is up a lot right now. But guys, this is right after COVID. Up until literally that point right there, it was essentially even. That was April of 2025 from August of 2020. 5 years of no growth. Why? People had already gotten their big gain here. There's a million, and guess what? The funny part is Amazon made far more money here than here, far more revenue here than here. This is the point. It is possible to be overvalued. Now, here's the part that really stood out with Dalio. He isn't telling people to sell. And I get it. He's got the world's biggest hedge fund, so there's a bias in there that you have to at least be aware of. He said what actually popped was the bubble isn't the bubble itself. It's the prick that hits it. And as I said before, I don't necessarily agree. I believe that crashes can happen, corrections can happen, bear markets can happen just because of exhaustion. When people or companies need money fast, they're going to start selling their investments. And that selling pressure is what can bring the market crashing down. Now, what would get people to want to sell their stuff fast? Well, what if we had a recession? Or people aren't getting the returns they want from this, that, or the other. Or Bitcoin falls and all the people who had Bitcoin and borrowed against it, we don't know what it could be. The point is, guys, I don't want you to be the person forced to sell. Because when you're forced to sell, you're not going to make good money. When you have the opportunity to buy from people who are forced to sell, you're going to make a lot. So let's talk about what a stock market bubble actually is. A bubble happens when stock prices go up way too fast, way too high, because people get caught up in hype and excitement, and it's completely detached from the fundamentals. Everyone starts buying just because prices are going up. They have FOMO. Their neighbors bought it. Everything's going up. Think things like Bitcoin or all the other hype, EV companies back in the day or cannabis, no fundamentals behind them. It usually starts with a great story, like a new technology or a new trend, and people start believing in some way, shape, or form this time is different. Hey, remember Beanie Babies back then? Remember tulips back 400 years ago? Remember this speculation? Oh, but Bitcoin's different. It's a technology. We use it everywhere. Okay, sounds good. Now, what could prick the bubble? 1,000 different things. I have no idea. The bottom line is anything can cause the bubble to pop, or nothing. It's just people get exhausted. Now, here's where it gets even more interesting. In that same video, Ray Dalio shares a big concern about the next 10 years of stock returns. The reason it's interesting is it's something we talk about pretty much every valuation video we make on both of our channels. He says we might be entering a period where returns are much lower than what investors have gotten used to. And if he's right, that means the days of easy money of 15, 20% every year could be behind us for a while. That's what we're going to talk about next. Now, guys, this is my version of a stock market to GDP ratio, made famous by Warren Buffett. He calls it the single best indicator at any given moment on stock market valuations. We are currently 120% overvalued. Not 120% of value, 120% overvalue, with fair value on the S&P of 3,003. As you can tell, going back the last few years, it keeps going up because as GDP goes up, it makes sense. If the US economy gets bigger, what should happen to the companies within that economy? They should grow along with it. So this makes perfect sense. Now, here's the scary part. This data goes back 100 years. The average return over 10 years without dividends is 6.4%. When we have undervaluation, 30% or better, like so 30, 40, 50% undervalued, the average return is 10.7%. And as you get to more normal valuations and overvaluation, look what happens to the returns. 10.7 becomes 9, becomes 2, becomes a negative 1.1, negative 2, and negative 2.4. And the negative 2.4 is for everything 50% or more overvalued. I repeat, we are 119% overvalued. For those of you who understand math, the correlation is a negative 0.82. That is a very strong inverse correlation. What that means is, as overvaluation goes up, return goes down. As undervaluation gets better, returns go up. And every time you go in the past, before this recent bull market, and look at overvaluation versus under, guess what happens? The thing you expect happens. When you buy cheap, your returns are good. When you buy expensive, returns are bad. But in the moment, it's so hard to think that way. We're sitting here and stocks just go up every freaking day. Yeah, the market was down last week. No big deal. We have a new generation of people who've never experienced a long-term bear market. Hope is not a plan. I used to buy stocks hoping that they would go up. But hope doesn't protect you when the market turns. Hope doesn't help you sleep better at night. Hope doesn't decrease your fear. I had to learn how to build a real strategy, one that makes sure that I personally never go to zero. Now, every investment I make is based on numbers, not hype. This is why I built Everything Money. It was built for me. I wanted the tools that gave me clarity, took the fear out of investing, and helped me make better decisions that helped me sleep better. People saw me using them on YouTube and said, Paul, can you give us that software? And I said, well, I can't because it's mine right now, but I can create it. And so I did, and a real community was born. Real people sharing ideas, live chats, live streams, and tools that help beat 99% of investors. I still use these tools like the stock analyzer every single day. Stop guessing, start learning. Click the link below, try our trial, $7 for 7 days, and see how confidence will replace your fear. Now, guys, this is Goldman Sachs. Goldman Sachs says, watch these 5 warnings from the dot-com bubble to know the AI craze is peaking. And I've said for a long time, this reminds me a lot of the dot-com bubble. I got into investing in the mid-90s, rode that dot-com, thought I was a genius because these stocks, I went up 98.6% one year. I was a genius. Then it all came crashing down. First thing, a peak in investing spending. A broad-based investment boom. So this is 2000, the dot-com era. Boom to bust. Now, I will say, when the stocks started to fall, that's when investments started to fall. So it's kind of a lagging indicator. I don't know if I necessarily agree with this. Look how this is here, this is here. I don't know. You can't. I mean, maybe this started it, and then it was a perpetual feed into that. That's probably some self-fulfilling prophecy. Guys, in fact, I see recently Meta, People are still spending a lot of money on capital expenditure, so we might not be there yet. We don't know. Anybody who says otherwise is completely guessing. Let's look at number 2. Corporate profits start to fall. Well, of course, it makes perfect sense. 1997, middle of 97, profits started to fall. Now, percent of GDP. It went from 10.5 down to 7.25, back up to 8. It started at 8.25, 8.33. So it's not like it's huge numbers. This makes it a lot more exaggerated than it actually is. But still, corporate profits falling would be something to cause concern. But I want you to stay with our channel long run. Why? Because when corporate profits start to fall, we'll sit there and say, yeah, but what's the normal corporate profit? What should it be? Don't buy based on this and don't buy based on this. There's a more normal level of corporate profits you have to understand. Number 3, corporate debt rose sharply from late 1997. Now, I will say, corporate debt now has been kind of different lately. Yes, I know some companies are raising debt, but rates have also gone a lot higher. It's going to be still bad. In the late 90s, we still saw interest rates falling from the early 80s. We were still in a continuous fall of interest rates. Now it's exactly the opposite. Interest rates are much higher than they were 5 years ago. So even if corporate debt levels stay the same, when they refinance those debts, just like if you had to refinance your 3% mortgage today, how much would your mortgage payment increase? That's going to cut into corporate profits. Now, number 4, which I don't think they label it number 4 here, Fed cut rates. Guys, we've said this 1,000 times. Why does the Fed cut rates? They don't cut rates in a booming economy. That's inflationary, doesn't make sense. You cut rates when things are not doing well. They're starting to cut rates now. Are we going to look back in this period and say, oh, things were slowing down? Because you still hear about 20% increase in foreclosures year over year. You have credit card levels that are insane and credit card delinquencies are crazy. You see people paring back at Target and Home Depot and Lowe's, but they're spending at Walmart and things like that, trying to save money. And the 5th one, credit spreads widened. This is what this means, guys. When things are really good, bankers are okay saying, we don't have to charge as much over the interest rates because you're probably going to pay it. But when they start to tighten that, it's because they're starting to get a little apprehensive about the future. When they tighten their lending, that means they increase credit spreads, makes it more expensive for you to borrow. So for example, the 10-year treasury is 4%. Let's say your bank said to you, hey, if you want to borrow money for 10 years, we're going to charge you the 10-year treasury plus 2%. So 4% plus 2% equals 6. But if they were a little worried about the economy and what was going to happen, they might say, you know what, we need to charge you 3% extra. They're going to increase that spread they charged. That's what this means. The spread goes higher when banks get more apprehensive. The bubbles burst in real estate because banks suddenly got tight when they realized they didn't have the right loans out there. Now, all of these points, Morgan Stanley, Goldman Sachs, they all said this. I don't care. To be honest with you, the funny part is they haven't even talked about the most important one. Valuation. These are why all these Harvard MBAs are morons. I love how everyone worries about all the shit that they worry about and not the one that matters the most. When you pay more for something, your return is less. When you pay less, your return is more. That's it. The rest of it is garbage. Every great investor says, I don't care what the Fed's going to do with interest rates. I don't care what's happening in the economy. Can I buy a great business at a great price? And when you buy the S&P 500, you're buying the US economy. If you're buying individual stocks, there are buys out there that are undervalued. It doesn't mean they're not going to go lower if the market has a fall. They will probably go lower. You have to be ready and willing to be able to buy as they fall. If you can't do that, you should not be in individual stocks. All right, guys, let's talk about why I don't freak out when the market does. Even if there's a bubble, even if it bursts, even if stocks drop 20% tomorrow and 70% over the next 2 years. Here's the truth. I don't invest based on emotions. That's not investing, that's speculating. I invest based on principles. While everyone else is chasing hype or worried about the bubble, I stay calm because I focus on just one thing, the difference between price and value. That's it. I can only control when I buy. The stock market doesn't care what price I paid. Warren Buffett said this 1,000 times. That's the game. If a great company drops in price and the business hasn't changed, guess what? That's a buying opportunity. That's not a reason to panic. This is exactly why principle-driven investing matters so much. But you've got to remember, news follows the stock price. So as stocks fall, all the news will come out to tell you why the stocks are terrible, a specific company, etc. And some of them might be true, but good fundamental businesses, it won't be true. This is exactly why principle-driven investing matters. It keeps you from falling into these emotional traps that crush most new investors, including myself back in the day. The market is just an auction. A bunch of people yelling prices back and forth. But just because a stock moves up or down doesn't mean the value of the business has changed. Guys, speaking of auction, I have a great story. I have a lot of real estate. I love going to real estate auctions, but you know what I do different? At real estate auctions, their goal is to slowly bring the price up. They might sit there and say, we're starting the bid on this property at $2 million. If I've gone to my guys and I think I'm willing to pay $4 million, they'll say, do we hear $2 million? You know what I do? $3.75 million off the bat. And it always gets, what the hell did this guy do? Why? I want to scare everybody else into jumping up so high. That's the difference here. Everybody reacts to what's going on with the price in the auction. You should not. I do it as a way to scare people into this. You know why? If NVIDIA is $180 today, if tomorrow somebody said to you they wanted $300, you'd be like, I don't want to pay you that. But instead, 181, sure. 182, fine. Before you know it, you're at 300 and you're justifying 300 as a price. No different. That's why I go to auctions and immediately blurt out the highest price. And I guarantee you it saves somebody their money because I never get the property. That's not my goal. My goal is to sit there and stop the insane creep up. That's what I want to do with stocks. I stick to this process that works for me. I don't care if the stock is red or green today, red or green tomorrow, red or green yesterday, whatever's happening. I'm not here to trade. I'm here to buy great businesses at great prices that will build wealth in the long run. Unfortunately, that takes discipline, patience, and a rock-solid strategy. The fact that you're still watching this video shows that you probably have discipline and patience. Now, here are the 5 core principles I live by, and so does everyone in the Everything Money community. We're investors, not speculators. That's the first one. The second one is every investment is the present value of all the future cash flows it'll receive. So when you buy something, your return will be based on everything you earn in the future from there. 3, if we don't understand it, we don't invest in it. 4, in the short run, the stock market's a voting machine. In the long run, it's a weighing machine. 5th, and the most important one, a great story becomes a bad investment if you pay the wrong price. Now, guys, I don't expect you to memorize these today. I made a free, simple PDF that breaks it all down in plain English. No fluff, no Wall Street lingo, just the exact principles I use to stay calm, avoid mistakes, and make better decisions. This is your cheat sheet. When the market is swinging and emotions are high, you pull this up and remind yourself, I'm here for value, not for noise. So click the link in the description below, grab the PDF, start reading it today. Do what I do. I read it every single day. It's my reminder. I'm brainwashing myself into this belief system. It's simple, it works, and it'll help you invest like everyone thinks the pros invest, even if you're just getting started. So guys, there's going to be an opportunity at some point in the future to buy stocks at amazing prices. And guess what? We will be making videos someday where people are saying, Paul, you've been saying stocks have been cheap for a while. It will happen, and I want you to be ready when it does. So click the video link in the description. I will see you there. Thank you for your time.